So we left off, we were talking about income tax, everybody's favorite topic. Now let's look at how income tax actually works, because there's a lot of kind of myths about income tax. There's a lot of things people don't truly understand about income tax. So these are going to be for the 2016 tax year, which is already way outdated. The Trump administration in the past couple of years, since he won the election and became president in 2017, the Trump administration has kind of changed how taxes work. So we're kind of going off a little bit of older numbers, but the same principles are going to apply. The way it works is this. So we worked an example last time where some guy, remember he had, some wages. He made $46,500 in regular work wages. He got $1,850 in interest from a savings account. He also won 15 grand on a game show. So in total, that came out to like $63,000 roughly, or 61,000 or something like that. But remember, after taking out adjustments, exemptions, and deductions, his taxable income only ended up being $43,545. That's the income the government actually looks at to tax a person on. Remember, this is national income tax. So now that's just the taxable income. That's not what you're taxed. You're not taxed at 100% of your income. Goodness, that would be horrible. At any rate, that's just what your income is. Now what we need to do is we need to tax you in pieces. So there's going to be four, and I believe this is still four tax classifications. Those are still in place today. You can file as single. Now, that doesn't mean you might have a girlfriend or a boyfriend, but you're generally only going to file jointly if you're married, if you're legally married. So you can file as single, which is what most people probably file as, or a lot of people do. You can file married but separately. So you're married to someone else, but you guys decide to file your taxes separately. You can be married and you file jointly. So you file as if you were one unit, and it changes the tax information for you. And then finally, you could file as head of household. And if you're capable of doing that, you should, and you'll see why in a moment. But the thing is, head of household is something that's pretty rare. You have to be unmarried and paying more than half the cost of supporting a child or a parent, or even it can be a girlfriend, boyfriend, brother, stepsister, sister, someone that you're supporting who lives with you, and they're more than 50% reliant on your income in order to live. There's also certain rules. They have to make under a certain amount of money each year themselves. In fact, it's a really low amount. It's like $4,200. They have to make under $4,200 themselves. And so that's what it takes. So it's usually a child. But if you can file as head of household, look, the way the tax rate works is this. This guy had a taxable income of $43,545. The first, according to the 2016 rates, the first $9,275 of his taxable income is taxed at a 10% rate. Then every dollar he earned between $9,276 and $37,650 is taxed at 15%. Then all the money he earned between $37,651 to $91,150 is taxed at 25%. So the bottom line is, let's say, okay, so this guy made $43,545. So he is in this tax bracket right here. He's in this tax bracket right here. He is in the 25% tax bracket because that's where his $43,545 falls. But he's not taxed entirely at 25%. His entire taxable income is not taxed at 25%. No, no, no. The first $9,275 was taxed at 10%. Then the money between $9,276 and $37,650 was taxed at 15%. That's a huge difference. Then the money between $37,651 and then he made $43,545 total. Then that money is taxed at 25%. So in fact, only a small portion of his income is taxed at that highest 25%. Most of it fell into the 15% category. Some of it even fell in the 10% category. So in total, he ended up not really, it's not like all 25% or all of his money was taxed 25%. That's huge. There's a common misconception that was going around that this is called a progressive tax system. Progressive doesn't mean anything except the more money you make, the higher rate you are taxed at. So look, someone who's making more than $415,050, every dollar they make over $415,050 is taxed at almost 40%, but not all of it. So people were trying to make the argument that, well, let's say I was making exactly $415,000 a year right now, but then they want to give me a $100 raise, so now I'm making $415,100. They thought that suddenly all your income was previously being taxed at 35%, and now all your income is being taxed at 39.6%. And they thought, well, getting that $100 raise actually means I pay more in taxes. That's not true. You only pay the amount in excess of $415,050 at this tax rate. So that's not true at all. No matter what, the more money you earn, the more money that's kept in your pocket. It's just that the additional money you're earning might be taxed at a higher rate, but not the money prior to it. That's a huge difference. I can't believe there were legitimate news sites going around posting that. And I was like, guys, that's not how the tax, it's not like they changed the law 10 years ago. It never worked like that. I can't believe that that people were putting that out. That is just lying. So anyways, let's see the tax calculation for this guy. Let me get rid of this. It's awful. Or in this case, for a woman. Let's see what her tax, they'll call it tax liability. In other words, how much you owe the government in taxes. So let's say you have a single woman who has no dependents. Her gross income adjustments, deductions, and any tax credits are given. We're going to use the marginal rates from the table. So first of all, this woman made $62,000 in the tax year for 2016. Now she's filing her taxes in 2017 for the 2016 tax year. She has $4,000 in adjustments. She gets to subtract that straight off the top. Her deductions, she gets to deduct $7,500 in mortgage interest. She gets to deduct $2,200 in property taxes. She gets to deduct $2,400 in charitable contributions and $1,500 in medical expenses that weren't covered by insurance. Now remember, first of all, we're going to subtract the adjustments off the $62,000 to start with. So I'm going to have to keep flipping back here. But anyways, the first thing we need to do is calculate her adjusted gross income, her AGI. It was her gross income. Gross is everything. Gross is the whole thing, regardless of anything else. Her gross income was $62,000. She got to take $4,000 in adjustments off. And so her adjusted gross income was $58,000. Then she gets to take off certain exemptions, deductions. She gets to take, in this tax year, $4,050 off for herself. She didn't have any other exemptions, meaning she didn't have any children or things that were she was claiming on her taxes. So this is the only exemption she gets. Then you look at her deductions. She had $7,500 in mortgage interest. She had $2,200 in property taxes. She had $2,400 in charitable contributions. However, she does not get to deduct the medical expenses unless that she only gets to deduct the amount that is more than 7.5% of her adjusted gross income. Since her AGI was 58,000, 7.5% of that is 4,350. She only gets to deduct those medical expenses if they exceed 4,350 and only the amount that exceeds 4,350. So if her medical expenses had been $5,000, she would only get to deduct $650 because that's the amount that's beyond 4,350. So in this case, since she didn't have at least 4,350 in medical expenses, she doesn't get to deduct that at all. Now, I imagine that has changed or will be changing soon, because what is today? Election day. Today's election day. We're likely going, well, we're going to find out whether or not we're going to get a new president come January, or if we're going to keep the current president. We will know by tonight. So the thing is, this stuff changes every year. That 2016 tax year, that would have been the last year of a full Obama administration. And then even the 2017 tax year probably still would have been under the Obama administration's tax plans. Starting with the 2018 tax year, 2019, that would have been the Trump administration plans, and Trump completely changed things. He made these exemptions. He made it look like your personal exemption went away, but he actually just increased the standard deduction to complement that. And anywho, she has a total of 12,100 in deductions. Now remember, that's called itemizing your deductions. If you add them all up and it goes beyond the standard deduction, then you would itemize. Since her itemized deductions were 12,100, that's beyond the standard deduction. So she's going to take an itemized deduction and really truly use the 12,100. But if for some reason her deductions when she itemized only came out to $1,100, well, you want to deduct as much as possible. So you actually get to choose the greater. You get to choose between the standard deduction and your itemized deduction. You get to choose whichever one's larger. So if you only had 1,100 in itemized deductions, no, you need to choose the standard deduction because you want to deduct as much as humanly possible because that lowers your taxable income and that in turn lowers the amount of taxes you owe. But in reality, she had 12,100, thus she's going to itemize her deductions because that's now the larger value for her. However, the standard deduction used to be 6,300. Trump raised that. He like doubled it almost. But he also took away the personal exemption. And so it's kind of just 6 of one, half dozen of another. But now the standard deduction is a lot higher than it used to be, which for your tax bill is good. You want to get as much exemptions, as much deductions, as much adjustments as you possibly can going your way. And this is confusing, I admit it. So finally, she's going to take her AGI. She already subtracted that 4,000 out. She's going to subtract off the sum of her exemptions, which remember, that's no longer around, but for the 2016 tax year it was. She gets to exempt 4,050 for herself plus the 12,100. In other words, she gets to subtract another 16,150 off of her income. And so now her taxable income is just 41,850, which is great. You want to get, you want your real income to be as high as possible. You want your taxable income to be as low as possible, because the lower your taxable income, the less you're going to get taxed, the less money they're looking at. So always you want to get as the lowest taxable income possible. Okay, so now here's how it's going to work. The amount of income tax you owe, we need to do the tax computation off of this $41,850. So again, it is a little bit complicated. It's kind of ugly. So her taxable income was $41,850. $41,850. So I'm going to remember that. I'm going to write it down. Her taxable income, the real number that mattered most, was $41,850. So The first $9,275 of that is only taxed at 10%. Then every dollar she earned between $9,276 to $37,650, excuse me, is taxed at 15%. And then finally, from $37,651 to $41,850, which is then the highest she went, she is taxed at 25%. So again, we're going to say that because her taxable income fell in this range, she's in the 25% tax bracket. But all that says is that's the highest amount your income could possibly be taxed at. But a lot of it's going to be taxed at a lower amount. So let's look at the actual computation that was done. And yeah, you're going to have access to these charts. You don't have to memorize these charts. What do I look like? Do I look like some guy, you know, is prodding you with electric cattle prods? You think I'm going to make you memorize these charts? They change every year. This is awful. No, you're not going to memorize these charts. I want you to know the process behind it, the process of calculating the person's taxable income, and then how to calculate their actual tax amount. All right. So 10% on the first $92.75. Then 15% on all her taxable income between these two values, and then 25% on all her taxable income up to her full taxable income. So it looks a little ugly. It looks a little bit ugly. Let's break it down. Let's break it down. So first, you take 10%, 0.1, times the first $92.75. Then you're taxed at 15%, but only for the amount of money she made basically between everything over $92.75 up to $37,650. So we actually need to take $37,650 and subtract $92.75, because then that middle amount, that's the middle $28,375 of her income. That's only taxed at 15%. Plus, finally, her taxable income was $41,850. She's taxed at 25% for every amount between $37,650 up to, what was it, $91,150. And since that's her tax bracket, we only go up to her taxable income itself. And so we take 10% of the first $92.75 plus 15% of the next $28,375. And then 25% of the next $4,200. So if I were to add $92.75 plus $28,375 plus $4,200, that would give me her full taxable income. But I'm taxing it in pieces. It's really weird, but it benefits you to be taxed in pieces like that. Would you rather all of it be taxed at 25% or only this small smidgen of it and then most of it taxed at a lower amount? Well, yeah, you'd rather have it taxed at a lower amount. This is America, and America is all about keeping your money so that you can take your money and you can buy a bunch of gold bullion bars and bury it underground. That's what I do with my money. I say, all right, here's my income for the month, subtract off my bills for the month. Okay, this gives me this much. Time to go to the gold bullion store, buy me some gold bullion and put it in a treasure chest and bury it underground. Will I ever do anything with it? No, I just like to know that I'm sleeping on my gold. So a very weird situation I put myself into. Josh, do you live out like in the middle of nowhere? You know, are you like a hermit? No, I live in a regular neighborhood. Nobody knows where my gold is. They never shall. This joke's getting weird. So moving on. So in total, she had $927.50 from the first part. Then she owes $42.56.25 for the next part. Then $10.50 of the next part. In total, her tax amount, the amount she owes the government, would be $66,233.75, except she gets a little bonus. There's things called tax credits. They don't count as deductions or anything. A tax credit is simply $500 off the tax you owe, which is actually a little bit better than deducting $500 from your taxable income. Because when you deduct money from your taxable income, you're just lowering the amount that you can be taxed on. But when I give you a $500 tax credit, that's $500 directly into your pocket after all other computations are done. So she should owe $6233.75, But since she had a $500 tax credit, we just knocked that off. And so now she owes $5,733.75. Super groovy. So she owes the government $5733.75. Now let's talk about how when you get your paycheck, how does your paycheck work? Well, depending on the type of employee you are, if you're a standard W-2 employee, which is what most people who are employed in this country are, they fill out a document called a W-2. It's just them declaring their tax status, how they, how the money should work, how their pay should come out, blah, blah, blah. If you're a W-2 employee, your employer is automatically going to take money out of your paycheck for taxes. So let's say you earn $15 an hour and you work 40 hours a week. Your gross pay is going to be $600 a week. 15 times 40 is 600. So you'd expect every week or every 2 weeks, however much, you expect to get $600 per week. But then when you look at your paycheck, you're only getting $472.50 a week. It's because your employer has already taken out money for taxes. But now let's think about it. Let's say that this person who we just calculated her tax liability, how much she owes the government, let's say her employer had already taken out a total of $8,000 from her paychecks throughout the year. So what this means, let's say her employer has already taken out $8,000 throughout the year from her paychecks. Why did the employer take out too much? Because the employer doesn't know that person's individual everything. The employer doesn't know exactly how much money they're making, if they have other income sources. They don't know how many children they're supporting. The employer doesn't know any of that stuff. So the employer overestimated how much they owed. So 8,000 minus 5733.75. Y'all are gonna make me do math. 22, what is that? 66.25. Don't quote me on that. I might be wrong. I'm in the right ballpark though. She has overpaid by $2,266.25. So what does that mean? That means that the government owes her a fat check of $2,266.25. That's what your tax refund is. Your tax refund is not magic money the government's giving to you and saying, run off into the fields and spend this money and buy yourself a PlayStation 5 or the new Xbox, or in my case, I'm gonna need a new laptop, it looks like, because mine's falling apart. The government's not magically giving you money to go have a party with. The government's just giving you some of your money back because you've already overpaid an income tax. That's all it is. Now that means a few things. That means that $500 tax credit she got increased her refund by $500. If she had not gotten it, we would have had to subtract an extra $500 off, and she'd have $500 less in her refund. So things like tax credits kind of are the government giving you some extra money here and saying, okay, here's some extra money to go to do with. I would look into tax credits if I were you. I know a very popular tax credit. I don't know if it's still around. I think it is, for young people who are full-time in college, is something called the Earned Income Credit. And if I remember correctly, as long as for every year you were full-time during college, you can get a tax credit of $1,000 from the government. You can claim that up to 4 total times in your life. And so it's either called the Earned Income Credit or that's something else. The Earned Income Credit, though, is something that is great for young people or for people who don't have a high taxable income. That could literally be $1,000 extra bucks in your pocket whenever it comes refund time. So I would go look that up. Go look up the Earned Income Credit. Go look up possible tax credits. If you're savvy and you stay knowledgeable about this, you can get back all kinds of money from the government, all completely legally. We are not lying or doing anything deceptive. So if you're a regular W-2 employee, can you still do tax write-offs? Absolutely. It just depends on the situation. So a tax write-off, generally what you mean by a tax write-off is that you're a business Yeah, you're a business and you're deducting your costs of doing business. That gets into a little murky situation. If you're a W-2 employee, but you also maybe have a side business and you have a separate income that's being earned from a 1099 or something like that from a self-employment income, then yes, you can write off your expenses that it took you to do the business because the government's only going to tax you on your profits from doing business. If you're only a W-2 employee and you take on certain costs to help you inside of your job, that gets a little dicier. So you just have to look at what it is. I know teachers are technically W-2 employees, like high school teachers, middle school. But if they put money into like making their classroom look nice, I think they can write off that amount of money, but that's like a special exemption. Exactly. So it just depends on what you have. Because if not, I mean, everybody could deduct the cost of, gas that it took to drive to work. And I don't think they usually allow that. Yeah. But if you're self-employed, you can deduct that. But the problem is self-employed get taxed in a completely different way. So, and it can bite you, that big tax bill. It's bitten me in the behind. Yeah, yeah. You can download an app on your phone. Yeah, it's great. If you're self-employed and you have to go drive around for whatever reason. So if you're self-employed, you're not going to be a W-2 employee. You're going to have a 1099 EZ, a different tax form. But basically, you're getting in your car, you're going to go do some driving for work. You just go hit the app and say, okay, I'm driving for work, and it's going to map you and it's going to calculate. And then you say, okay, I'm done driving. It's going to calculate how many miles you drove for work in a given year. You can go put that into your tax thing when you're ready to file your taxes, and you can deduct the amount of gas it's suspected that you used and wear and tear on your car. So here's the trick. While this stuff is a little bit complicated, I'm not going to lie about it, it is. And maybe some of this stuff was a little confusing. Oh my goodness, bury yourself in it because you can save thousands of dollars completely legally, 100% legally. What is not legal is going on saying that you are supporting 99 children in your house. Like I told you, I literally had a student when I was teaching this class 2 semesters ago say, oh, I have a coworker who claims 99 children. He gets 99 exemptions worth $4,000 each or something, and he has never paid a dime in taxes. Like the IRS is going to figure it out sooner or later, and they're going to bust him, and they're probably going to throw him in jail. So what I'm telling you, the ways I'm teaching you to save money here, all 100% legal, and it's all just kind of the game that you're playing with the IRS. This is all in the game. We're not cheating on the game. But as you can tell, this stuff really interests me. There's some other taxes we won't go into uber detail about. The money that comes out of your paycheck, some of it is for income tax. Like I said, that's why you're getting a refund. Some of it is money you're never going to get back. You literally just have to pay it out of your paycheck and it's gone. That comes in the form of Social Security and Medicare. Briefly, Social Security, if you're paying Social Security, what you're doing is right now, out of your paycheck, you are paying for people who are currently retired and getting Social Security from the government. You're paying for them to have those benefits. In turn, the longer you work and pay into Social Security yourself, and the more you pay in, if you're earning more money, you pay more in. Those factors combined tell you that if you're ready to retire, you can collect Social Security yourself when you were ready to retire. So it creates kind of an interesting thing because it's not the same as taking money, saving it, and putting it into an account that's only for you and then investing that account. It's just saying you're paying for people who are currently retired, and the younger people will pay for you when you're retired and collecting Social Security. One thing I'll say is sometimes you can opt out of paying Social Security if you agree to save a certain part of your paycheck yourself and put it into a retirement savings account. But we won't go into uber duper details about that. But basically, Social Security and then Medicare is a separate program, but we pay for those things. Those are called our FICA taxes, Federal Insurance Contributions Act taxes. The way it works is that 7.65% of the first $118,500 of your income goes to FICA. And then if you make more than 110,000, 1.45, or if you make more than 118,500, only the amount you make over that is only taxed at 1.45%. So it's a little bit tricky, but that's money that's coming out of your paycheck that you're usually not going to get back. Although it can be tricky depending on your situation. So if you're a regular employee and you earn 150 grand, you're going to get 7.65% of your first 118,500 taken away. And then after that, you're taxed at a much lower rate. You're only taxed 1.45% of everything beyond that. So in total for the year, you paid $9,522 in FICA tax. And that is separate from your national income tax. That's a separate tax altogether. And it's usually taken out of your paycheck automatically if you're a W-2 employee. The thing is, your employer covers half that tax, you cover the other half. But if you're self-employed, you got to cover the entire thing yourself. That's why it's 15.3% for self-employed and 2.9% beyond that amount. So being self-employed is not all cherries. Another thing about being self-employed, you have to have the discipline to take your earnings and take out income taxes yourself. Every person who has ever been self-employed has had their very first year where they earned a legit amount of money. It sucks. Then they didn't know they had to do that. And yeah, so you'll come up, you got to file your taxes the previous year, and you didn't realize, you're like, ooh, what's my refund going to be? And then it says you owe $9,000 to the government. Everybody who's self-employed has had that story almost if they didn't know about this. When you're self-employed, instead of being a W-2 employee, your tax form is called a 1099 usually, or a 1099 EZ. And it just depends on your situation. And what you don't know is that the money you're earning, you got to take the taxes out yourself because there's no employer doing it for you because you're your own employer. So you got to know to do that. And the government then requires you to file your taxes quarterly to put aside an amount each quarter every 3 months so that you don't get hit by a giant tax bill. If you don't file quarterly, it's not illegal. It's just you might owe a slightly higher tax bill because they charge a mild penalty on the amount you did. So again, tax law is out of this world, insanely complex. I'm trying to give you a taste of it. But yeah. So next time you look at your paycheck, you'll see Medicare and Social Security gets taken out. Those are your FICA taxes. You'll also see they'll take out for your retirement plan if you have one. They might automatically do that. They'll take out for your projected income tax. They might do that. So it can just get really nightmarish. But the nice thing is, if you are a working student, the government generally promotes people going to school. So if you're working, even if you're working full-time and you're in school full-time, I would investigate certain tax benefits to you. You can get certain tax credits. That's nice. That's an extra amount of money in your pocket. So we won't go over shortly, or we won't go into too much detail. But basically, if you're making $300 a week, say working at a gym, you make $15 per hour, 20 hours a week, that's $300 a week. Well, they're going to take, you're probably at the 10% federal tax level. So they're going to take 10% out of your paycheck for federal taxes. Then they got to do FICA taxes. They're going to take 7.65% out. And so in total, they take $61.95 out of your paycheck. So the actual amount of money you're going to get in your paycheck, you earned $300, but you're only going to get $238.05, which in turn means they're taking about 20.7% of your paycheck out, and you don't get that money right away. Now, the truth is, they're taking out for income tax. You might get some of that money back later on in the form of a refund. But just in the immediate sense, they're taking out a big, nice chunk of your income. So we all hate paying taxes, I'm sure. We all say it at least. But we all kind of have to. It's however you want to see it, it's kind of our shared responsibility. to pay taxes, whether we like it or not. Of course, some of the major political controversy right now is how much should people be taxed at? Generally speaking, Republicans like to lower taxes. Democrats like to raise taxes. Why? Does that mean one of them is evil? Does that mean Republicans are evil? Does that mean Democrats are evil because they're trying to tax you higher? That's personal opinion. All I will talk about is the fact that, generally speaking, Republicans think money should be put into your pocket so you, the consumer, have more money to buy things with and boost the economy. That's their theory. Democrats would say, well, you still have money to buy things with and boost the economy, but we also need that tax money to perform certain operations of the government. And the way that tax money is spent by the government is a major point of difference between Republican and Democrat ideology. But I never, ever share my own personal political beliefs. I have had, and I'm proud of this, I have had students ask me after the end of the semester, they'll come up and say, Josh, you're clearly a Republican. I've had another student come up to me and say, Josh, you're clearly a Democrat. Literally, I've had multiple students tell me that I'm both sides of the aisle. And it's because I don't reveal my political beliefs while we're learning things in class, because this is a math class. I don't need to influence you with my religious or political beliefs because it's irrelevant. I believe that you should live your life well. There's certain principles to living your life well, basic ones like don't kill each other, but also don't cause harm in general to each other. Those are things I'm definitely in favor of, but my specific beliefs, I keep to myself. Also, I don't want someone telling me that I'm believing the wrong things. I hate that too. No matter what, I don't like people coming up to me and saying, you believe this while you're wrong. And I don't care to have a debate about this because this is a math class. It's irrelevant. Anywho, so that's going to cover our income tax chapter. And I'm salivating here. I'm chomping at the bit because, I love chapter 8 so much. We get to talk about money. And, math nerds, we love money because money is all about numbers. And we like to grow our money and put it into accounts and save it. Or we like to see how money changes. This is just a math nerd's dream. Look, I'm going to be completely blunt with you. I understand that some of the algebra stuff we learned, like solving equations and fractions and all that, is a pain in the butt. I am not blind to that fact. It is necessary for our understanding, though, of these higher level principles. But for the most part, yeah, it's kind of a pain in the butt. And so that means for me teaching it, it's not always the most fun thing in the world to teach, especially graphing certain types of equations. That's not always the most fun thing in the world, but I put on a smile and I say, yes, I can do it. But this stuff, I love teaching this stuff. I love talking about money. Money is fun. So let's talk about interest. Let's talk about personal finance. There's two primary forms of interest, simple and compound interest. The first thing we have to focus on is simple interest. But in reality, simple interest doesn't really exist so much in the modern world today. It doesn't show up as often as compound interest does. Simple interest is usually going to happen if your friend needs to borrow $500 from you and you're like, well, I could have used that $500 to go buy a PlayStation 5 or the new Xbox. So you're like, okay, well, since I don't get to have that money, I'm going to charge you interest. I'm going to charge you, $20 a week until you can pay me back the full 500. Because the $20 a week does not change. It's not like it's 20 this week and then it's like $20.32 the next week, and then it's $20.68 the next week. Because the amount of interest earned stays the same over time, what we're going to say is that is a simple interest scenario. That would be a 4% simple interest rate, it sounds like. So simple interest, what's interesting is whenever you hear about your student loan interest, if you have student loans, if you have credit cards, those things charge an exorbitant interest. That's all going to be compound interest. And compound interest is actually worse for the borrower. But it's just how the world works. Excuse me. Another thing that might interest you, I hate making puns. That was an unintentional pun. I also hate when people say pun intended. I hate that too. So I'm just going to have to pretend I didn't say that. Please ignore my previous statement. But if this piques your concern, what's interesting is that in kind of ancient times, especially in Middle Eastern culture, it is considered, or at least it was considered, immoral to charge interest on a loan. If you loaned your friend $1,000, or if a bank loaned someone $1,000 or $10,000, Middle Eastern culture in ancient times felt that that was immoral because a person who's borrowing money needs that money usually to live on. They need to make, their house payment, their rent payment. They need to buy food, whatever they need. And it was considered immoral. It was considered robbing them to say, okay, you got to pay me back with a little bit of extra cheddar on there. That was considered, immoral. And it's funny because nowadays that's just not the case. It's just considered the norm, but there are reasons for it. So at any rate, we're going to talk about interest. In order to talk about interest, we have to define a few terms. So interest is the amount that we pay for lending money or borrowing money. In other words, if you borrow money, you have to pay back more than what you borrowed as a little bit of like a thank you, wham bam, thank you ma'am. You're giving extra money back because that's what they're charging you. So in other words, interest is kind of like the rent you're paying on the money that you borrowed. And as long as it's borrowed, you got to pay rent on it until you've paid it off. That's a good way to think about it. So the amount of money that is initially deposited if you're investing the money, or borrowed if you're borrowing or lending money, that's called the principal. So the principal is the starting amount. It's the amount at day zero. Now, the amount of interest that has to be paid back or that accumulates depends on the principal. So the more you borrow, the more you deposit, the more interest you'll get. It also depends on something called the interest rate, which is the percent of the principal, at least for simple interest. It's the percent of the principal that gets tacked on to how much you owe every time period. So for instance, if you borrow $1,000 today and you keep it for 5 years and they charge you 6% simple interest, well, 6% of 1,000 is $60. So each year that you keep that $1,000 and not pay it back, they're going to add $60 on top of what you owe back. So after 5 years, you've accumulated $60 worth of interest each year for 5 years. That's $300 total dollars you owe back on top of the original $1,000 you borrowed. So in the case of simple interest, in that particular scenario, you're going to owe $1,300 when all is said and done. You're going to owe that much money back. So that means $300 in total interest was accumulated from that borrowing. Notice that for simple interest, the $60, the amount was only ever based on the principal. Compound interest updates the amount that is owed back every time period and then charges interest based on that updated amount. And you'll see that it's different. So simple interest only involves interest calculated on the principal. Compound interest calculates interest on the principal and the interest that's already being earned. So we have a couple of formulas that we cannot avoid these. Now on an exam, you'll be supplied with a formula sheet. But I'm going to tell you right now, a formula sheet is almost a handicap. A formula sheet almost hurts you on an exam because you're going to get this big idea that, hey, I have a formula sheet on the exam, so I don't need to study. I just got to look for the right formula and plug it in. And that's ridiculous. That's not how it works at all. It can give you a false sense of confidence. In reality, the formula sheet only helps so you don't have to memorize the formulas straight up in your brain and get them all mixed up. But you still have to identify the proper formula to use, and you have to be able to use it appropriately. And that is not as easy as it sounds. That is much more difficult than it sounds. So that's going to be where it's kind of brought on, where the difficulty lies. So the amount of interest that you'll have to pay on a certain loan is the principal of the loan, the amount borrowed, times the interest rate expressed as a decimal, times the amount of time. So I equals PRT is a pretty common way to express it. So for example, so this can be either money you're borrowing, or if you're depositing money and letting it grow with interest, it's the same idea. It's the exact same idea. So let's say you deposit $2,000 in your savings account at Hometown Bank, which has a simple, why is it not letting me change it? Okay, it's read only, I guess, which is going to have a simple interest rate of 6%. So you put $2,000 in the bank. Every year, it's going to get 6% of that original $2,000 added on as interest. So you deposit $2,000, 6%. At the end of 1 year, we can use the simple interest rate formula. 2,000, the principal, times 0.06, the interest rate expressed as a decimal, times 1 year. And so after 1 year, you're going to have $120 in interest. The total amount you're going to have in the account is $2,120. You'll have earned $120 in interest. Now that sounds great, but if you're depositing money, you want compound interest, and we'll cover that in a moment. Let's say you took out a simple interest loan for $1,800, and you're not going to make payments on it. You're not going to make payments over time. You're just going to pay back the $1,800 with interest 2 years down the line. So you take out a simple interest loan for $1,800 for 2 years at a rate of 8% to purchase a used car. Great. Find the interest on the loan. So you take $1,800, you multiply it by the interest rate of 0.08, and multiply it by the 2 years. You're going to see that when it's time to pay back the loan, and you're going to pay it back all at once at the end of the 2 years, you not only owe the original $1,800, you owe an extra $288 for a total of $2,088. That's how much you're going to owe back to whoever you borrowed it from. Now, banks, credit unions, financial institutions don't give out simple interest loans. Not only that, but loans they do give out, usually you have to start paying them back right away, and you might make monthly payments. So if you buy a house, you make monthly payments. If you buy a car, you have your car payment each month. That's a completely different setup, and one we're not set up to handle just yet. But we'll deal with that later. How can we calculate that payment? But for now, for these simple interest setups, it's much easier. Now, if we wanted to calculate the full amount that is owed, or the full future amount, then we need to use a slightly different formula. If we let A represent the future value of this account or this loan or whatever it is, P is the principal, R is still the interest rate, a simple interest rate, and T is the number of years, you would use this formula to calculate how much money is owed back. This is the number 1 here. This is not L or any kind of weird variable. This is the number 1. So the formula is A equals P, then in parentheses, 1 plus RT, close parentheses. So this tells you the total. So if you were to go back to this situation where you borrowed $1,800 for 2 years at 8% simple interest, this PRT formula gave us the $288, the amount of interest, but this formula would have actually given us the $2,088, the total amount that is owed back to whoever at the end of the 2 years. So we just finished off that simple interest example. Now we're going to look at compound interest. Compound interest works completely differently. The same basic idea is there in that interest is the amount of rent you're paying for the use of borrowed money. Or if you are depositing money, interest can be seen as the amount your money's growing by because it's being invested. Now think about it. What does it mean to invest? Well, let's say you go buy $1,000 worth of stocks, and then some news comes out that says, oh, uh, this new technology has come out, and you bought stock in the company who introduced the new technology. So the $1,000 stock you buy today, now because of this announcement, is now worth $1,200 tomorrow. That's quite a nice return on your investment for just one day. You made a 20% return on your investment, and then if you were to sell it, you'd get $1,200 for selling it, meaning you profited $200. That is a very, very, very simple idea of investing. Now, there's all kinds of things you can invest in. A popular investment vehicle is like real estate. You buy either a house or you buy land or something like that, or you're buying into a fund that has more money to be able to buy those things, and you just buy a share of that fund. So for instance, $1 million home, you may not have $1 million, but maybe you have $1,000. Well, if you have 1,000 and a bunch of other people have 1,000 and ultimately it makes $1 million, you can buy that home. And then if that home 10 years later is worth $2.5 million, which in Texas seems very on the table right now, why not? Real estate is going through the roof right now. Then you profited $1.5 million in the fund, and then everybody gets a piece of that based on how much the fund they originally paid into. So the whole point is you can buy all these different things, and if their value ends up going up over time, you bought when it was cheaper, and then you get to sell when it's higher. And thus you made a profit. That's what investing is. Now, in reality, you're not usually going to just buy a single thing. You're going to have what is usually called a diverse portfolio, which is where you buy this part of your portfolio is invested in this thing. This part of your portfolio is invested in some stocks. This part of your portfolio is invested in some technology markets, mutual funds. There's all kinds of fun things you can do to invest your money. The whole point of investing is to make more money than you brought in, so you're profiting. Compound interest is kind of going to be the type of interest that rules in the investment world. And it also rules whenever you're taking out loans. Another type of investment you could do, you could give a loan to someone else and have them pay you back with interest. That's also a type of investment you can make. In fact, there are apps out there right now where you can literally put money into the app. It will loan money to farmers in another country. And they're going to use that money to go buy farm equipment, to buy the seeds they need, to buy, to pay people for labor so they can farm. And if it turns out they have a good crop and they're able to sell off their crop and make more money than you gave them, they're going to be able to pay that loan back at a higher value than what you let them borrow. You're investing in them in a way. You can go do that like today if you really wanted to, but you're taking an awful risk, because when you lend someone money, you're taking a risk that they're not going to be able to pay you back, and they default on the loan. And when that happens, if you gave them $1,000 and they default, you get nothing back. You lost $1,000. So investing is not always, you're going to get more money than what you're going to get more money back than what you paid. That's not how it works. Investing inherently takes a risk of loss. Anywho, that's totally just a complete sidetracking thing, but this is stuff I'm super interested in. It's fun to invest and play the market, they say. The sooner you learn about it without even getting your feet wet and just kind of learn about it, the better. You can go to Yahoo's finance website right now. Google Yahoo Finance, go there. You can set up an account. And in that account, you can play the stock market, you can play investor with fake money. And you can say, they'll give you a budget of a fake $10,000. You're not actually making anything. You can take that fake $10,000 and you can go invest it in all these different things. Ooh, I'll put $3,000 into this emerging technologies fund. I'll put $2,000 in this real estate fund. You can have a fake portfolio and it will literally tie it to real investments and real stocks and all those things that are actually going on. And it will tell you whether or not your fake fund would have made actual money. In other words, it's a completely risk-free way to play the market just for you to learn how to do it properly. And you can learn very quickly that unless you know what you're doing, you're going to lose money, but at least you lost fake money. If you play this Yahoo Finance game for a couple years, and it's not, they don't make up the numbers are from actual real investments. You play that for a number of years, you might just start consistently making money. You might have figured it out, and it might be time to put some real money into those exact same investments, and maybe you can make some real money. So this is all fun stuff. I love talking about this. One thing I will not count as an investment is gambling. It's because gambling is designed for you to ultimately lose in the long run. Smart investing works a little bit differently. All right, so that's a fun aside. I love talking about this stuff. I could talk about it for hours, but yeah, go look at that Yahoo Finance thing. I forget what they call it. They call it like Market King or Queen or something. It's just a little game you can play, but it's based on real numbers. So compound interest is how the world actually works. Compound interest is how it really, truly works. Simple interest is nice, but simple interest charges you interest based only on the principal, based only on the original amount of principal. Compound interest, though, charges you in a completely different manner. It charges you in a completely different manner. So to play around with that idea, I'm going to open an Excel spreadsheet, and I'm going to show you some of the things or some of the differences between compound interest and simple interest. So let me set up this spreadsheet real quick. The nice thing about Excel is it can do all kinds of computations for us. Oops. So give me a moment, I'll set it up. So let me share with you what I'm thinking, what I'm seeing. Here's an Excel spreadsheet. I'm making it up myself. Let's say you have a principal. So this can either be an amount borrowed or an amount that you lend. Gabriella, did you raise your hand? You can just type out any questions you have in the text box there. So let's say, oh, I don't know, you have a $10,000 principal. Let's say you have an interest rate, or I'll just put rate, of 10%. But you don't know yet whether it's going to be simple or compound. We're going to compare the two. We're just going to compare and contrast the two. So if you would put that money, let's say you were investing that money. At year 0, you're going to have $10,000 in the account in both the simple and compound interest accounts. Let me just fix something real quick. So at year 0, you're going to have $10,000 in each account. In year 1, equals, hold on, I got to get the formula straight. Now, after 1 year, 10% of 10,000 is 1,000. So after 1 year, you're going to have now $11,000 in the simple interest account. After 2 years, you're going to get an extra $1,000 in there. So what we're going to see is a huge change. We're going to see a huge change, huge. In the compound interest account, you're still going to have $11,000. But after 1 year, things are going to start changing. After 2 years, you're going to have $12,000 in the simple interest account because each year it's just earning a steady $1,000. But here's what compound interest does. Compound interest says, okay, I'm going to take 10% of the first amount, add it on, now I have $11,000. But For the next year's amount, I'm going to take 10%, not of the original amount, but of this new updated $11,000. Completely different. Here, we only ever took 10% of the original principal and kept tacking that exact same number on. Here with compound, I'm updating it with new numbers. So now, after 2 years, the compound interest account is beating the simple interest account by $100. Well, I don't want to shatter your delusions of the world, but after 10 years, you're only going to have 20 grand in the simple interest account, but you're going to have $25,937.42 in the compound interest account. If you're investing this $10,000, do you want to invest it in the simple interest or the compound interest? Compound, absolutely. Because if you're investing, you want more money. If you're a borrower, would you rather borrow $10,000 at 10% simple interest or at 10% compound interest? Simple interest. So it's all about your perspective. If you're a borrower, you'd like to owe the least amount of money back. If you're the investor, you'd like the most amount of money to be in the account after so many years. Now, I want everybody out there to take a guess at how much money will be in each account for after 20 years. I'll tell you the simple interest is going to have 30 grand in it because it's $1,000 a year for 20 years. That's 20,000 plus the original 10,000 principal. So I'm going to tell you right now, after 20 years, this account will have 30 grand in it. I want everybody in the Zoomosphere, without doing any calculations, to just make a guess. How much do you think will be in this account after 20 years? It'll be more than 30,000. 45,000. We got a guess here in live. Let's see. Madeline is guessing 60,000. 60K will be in the compound interest account. Any other guesses? Anyone else want to try? The 60K is going to be about right. So after 20 years, whoa. That's not what I want. I want it. That. Come here. After 20 years, you're going to have $30,000 in the simple interest account, but you're going to have $67,275 in the compound interest account. That's wild. By investing in compound interest instead of simple interest, you're going to have more than double after just 20 years. Then how much do you think will be in each one after 50 years? I'll tell you, in the simple interest account, the amount that's going to be in there after 50 years is 60 grand. So hold on, where was I? So I need to go to 52. After 50 years, the simple interest account is going to have $60,000 in it. Now, I want everyone out there to throw me a guess. How much do you think is going to be in the compound interest account? About 200K maybe? Let's get some more guesses in there. About $120,000. What other guesses do we have? About 150K? Oh, my friends, prepare to have your minds blown. You ready? You're going to have $1,173,908.53. Dead serious. None of that was a lie. Agreed. Agreed. What? Are you serious? That is serious. This was not a lie. I did not make up or fudge any numbers. Yes, this is exactly what it looks like. The simple interest account is just getting a flat 10K a year. The compound interest account, though, is looking at the updated amount and now taking 10% of that and tacking it on. And while it doesn't, early on, it doesn't look like it really beats the simple interest account by a lot, it's going to go off the rails really quickly. So the idea is this: for the investor, compound interest is way better. And all I did was put $10,000 away one time and then just let it sit in an account for 50 years, earning 10% compound interest a year. And I had over $1 million. Simple interest, I only had 60K. So no question, compound interest is what you want as an investor. And in fact, that's exactly how it works. You don't invest money today in a simple interest account. I mean, that just doesn't happen except in silly, rare cases. That's usually just a loan between friends kind of thing. Also, if you were borrowing, let's say you borrowed 10 grand and you're not going to pay it back for 50 years for some reason, you're going to owe $1,173,000, plus in the compound interest account. You're only going to owe 60 grand in the simple interest account. So obviously you'd rather have the simple interest account if you're the borrower. So that's huge. So the way it works, we have a slightly different formula than the simple interest formula, but it's a huge difference. This T here, the time, it's no longer the simple interest formula was just 1 plus R times T. That was the formula for simple interest. But here, it's raised to the T power. This is an exponent. You are now raising this expression to the number of years of simple interest, or excuse me, of compound interest. Huge difference, huge. It makes for a huge difference in the final amounts. So we can look at a few examples involving compound interest. Let's say you put $2,000 into a savings account at Hometown Bank and you get a 6% return on your investment. You get a 6% interest rate. Pause, you do not get 6% from a savings account in this day and age. It does not happen. 6%, you'll do backflips over the moon if you do 6%, or that means inflation is so high that 6% is not nearly as much as it sounds like. 6% would be terrible. But let's just say for the sake of argument, you are getting a 6% interest rate, compound interest rate on your savings account. Again, no, not happening. Anywho, if that's the setup, then what we're going to say is the principal is $2,000. The interest rate is 6% or 0.06. T, you're going to put that away for 3 years. So using this formula, we do 2,000 times, in parentheses, 1.06 raised to the third power. Now, only according to this order of operations, only the 1.06 gets raised to the third. Then we multiply by 2,000. So your order of operations is huge here. It's very important that you pay attention to your order of operations. But that means after 3 years, you're going to have $2,382.03. I can tell you right now, if you had put this money, if you had a simple interest rate, if that was 6% simple interest, you'd have $2,360 exactly in the account. So just by using compound interest, you got a little bit extra. But over time, compound interest is a wild force of nature. Think back to that Excel spreadsheet. In fact, it's so powerful that at one point in the 20th century, Albert Einstein said the two most powerful forces in the universe are gravity and interest, and compound interest. Dead serious. Now, obviously, compound interest isn't a literal physical force, but he was making a point of saying how powerful compound interest is. It's insane how much it can do. So you had $2,382.03 in the account after the 3 years. The amount of interest you earned, well, you put $2,000 there initially, so we need to take the amount that's in the account after the 3 years and subtract off the $2,000 you initially put in, and that means your account earned you $382.03 in those 3 years. So the interest is found by taking the final amount in the account and subtracting off the starting amount. Now, here's where things get a little bit dicey. Here's where things can get a little bit dicey. We have our compound interest formula here. A equals P times 1 plus R to the T power. We have that compound interest formula, but what you may not know is that sometimes interest pays out more frequently than you'd think. So using this formula here would suggest that, okay, we only compute the new amount of interest in the account once per year because the interest is once a year. Well, what if instead we decided that the interest ought to compound monthly? What that means is that at the end of every month, we get a piece of our interest early. We get a piece of it early. So the way that we handle that, we introduce a variable n. And what we do is we say that interest n is the number of times per year we're going to pay out interest. So instead of waiting an entire year to get some of my interest, no, I'm going to take my interest rate, I'm going to cut it up into 12 pieces, and at the end of each month, I get a 1/12 of my interest each month. That actually leads to a slightly different calculation. So this is better to memorize as the more general compound interest formula. A equals P, open parentheses, 1 plus R over N, close parentheses, raised to the N times T power. And sooner or later, we're going to have to talk about how can we put this into the calculator. Grab a swig of water here. I get so excited I don't drink the water and then my voice gets raspy. Oh gosh, I love talking about numbers. But frankly, look, you can make fun of math nerds all you want. When it comes to money, there's no making fun. We all want money, or we all want to make it. We all want to be smart with our money. I'm teaching you how to do that right here. Okay, so before we really jump into this, let's do a little side work. N is said to be the number of compounding periods per year. In other words, the number of times interest is paid out each year. And I would say, gosh, I can't type today. But I say that literally every time I type something. So I think sometimes I just type too quickly. We're going to make a quick little table. If interest is, I have to give myself compounded dot dot dot. If interest is compounded, well, annually, semi-annually, quarterly, monthly, weekly, daily, and then we'll also talk about something called continuously. If interest is compounded that often, then N equals. So the N value you use, if we compound interest annually, that means that I have to wait an entire year to get my interest on my account. And then once I get it, I got to wait another year to get more interest. That means the number of compounding periods per year, N, is just 1. Semi-annually, when you're talking about finance, the word semi cuts it into 2 pieces. So N is equal to 2. Semi-annually would mean every 6 months. Thus, interest compounds twice per year. And then it's just kind of obvious after that. Quarterly, well, there's 4 quarters in a year. So instead of having to wait a whole year to get all my interest, if it compounds quarterly, then I get some of my interest each quarter. I only have to wait 3 months, then I get some of my interest. And then another 3 months, I get a little bit more of my interest for the year. Monthly would be 12 times per year. Weekly would be 52 times a year. Daily, you'd think is 365, but they usually just use 360 because 360, frankly, is just an easier number to deal with. So even though there are 365 days in a year, well, what about leap years? Okay, fine, then we'll just say it's 360 and just keep that a nice round number. Now, continuously would somehow mean that interest is always compounding. Thus, continuously compounding interest is actually compounding an infinite number of times per year. But this is a special case that uses a different formula. It's just really special and it gets its own special formula, and there's just not a whole lot we can do about it. We will introduce that formula, of course. And of course, you'll have your formula sheets on your exams. So you don't necessarily have to memorize this chart. Just tell yourself N in the formula is the number of time interest compounds per year. If it's annual compounding, then N is obviously 1. It's just happening once a year. You may just have to remember that semi-annual means twice a year. But quarterly, N would be 4. Monthly, N would be 12. So getting on back to it, here's the formula again. So let's do one. You deposit $7,500 into a savings account that earns an interest rate of 6% per year. Is it simple or compound? Well, the next line says the interest is compounded monthly, so it's automatically going to be this compound interest formula. Automatically, there's no sidestepping that. So how much money will you have in the account after 5 years? And then let's also find the amount of interest you earned in that 5-year span. Let's do both of those things. We're going to have to use this compound interest formula. This is the general one. I wouldn't even remember the other one that didn't have N in it because this formula just becomes the other one when N equals 1. So you don't have to worry about memorizing the previous one. This is the meat and potatoes right here. Okay, so your principal, P, $7,500. Your interest rate, 6%, convert it to the decimal 0.06. T, the number of years, is 5. N is going to be 12 because interest is compounding monthly. So we're going to put 12 into the formula. So now we substitute everything into the formula. P is 7,500. This is a 1 no matter what, plus 0.06 over 12 raised to the power of 12 times 5. Well, we can do a few intermediate calculations. We can do this 0.06 over 12 first, because the order of operations would suggest that. And the beautiful thing about it, 0.06 over 12 actually becomes just a very simple 0.005. Great. What if that was 0.04 over 12? It would become 0.00333333333, and the 3's would go on forever. What do you do in that case? I'll show you in a second. And then they just did the 12 times 5 up here in the power, which was 60. Then the next calculation we do is 1.005 raised to the 60th power. Is that something you can do in your head? No, raising to the 60th power means do 1.005 times 1.005 times 1.005 times 1.005. You keep doing it 60 total times. You're not going to do that in your head. I can't do that in my head. I certainly, even on pen and paper, I would be way off. I'd make a mistake somewhere, guaranteed, and it would take me like an hour. I'm not going to do that. That's why we need the calculator. So we are simply pushed into a wall where we actually require the calculator. So anywho, you do 1.005 to the 60th power. Whatever that gives you, you multiply by 7,500, and you end up with $10,116.38. Not bad. So in 5 years' time, you ended up with $10,116.38. Excuse me. $10,116.38. you started with $7,500. So if you subtract that off, that means you earned $2,616.38 in interest. What's really cool is that if you were to somehow get $2 million, if you won the lottery, or you had a relative pass away and leave you $2 million, and let's ignore taxes for the moment, because if you win the lottery, you pay taxes. If you inherit $2 million, depending on the state you're in, the state tax is usually not going to hit. It just depends. Anywho, let's say that's $2 million, no worries about taxes. If you put that $2 million into an account, well, here's what you could do. You could take that $2 million, say, I'm going to buy myself a $500,000 home. Then I'm going to go buy myself a $350,000 Bugatti, which is a very, very, very nice Italian sports car. I'm going to go and I'm going to buy myself, I don't know what else you could buy for that. I'm not very creative. I would just get a car and a house, right? You could do that. Or you can be smarter with that $2 million. You can take that $2 million, you can invest it, put it into an account, and let's say it earns 8% interest per year. Well, 2 million times 8%, that means every year it's going to earn $160,000 as long as you're able to get an 8% return on your investment. You could take that $160,000, give it to yourself, keep the 2 million in the account, and then next year, if it's invested well, it may just earn another 8%. And whoops. So next year you can pay yourself out another $160,000. Now, all that is getting an income off of a large nest egg or off of a large amount of money and never actually touching that amount of money. So when you pass away, you can leave that money to your kids or something. Here's an even better situation. You take that $2 million, you earn 8% per year, but instead of taking out all $160,000 it earned you, you only take out $80,000, pay yourself a decent, nice salary of 80 grand for the year, keep the other 80 grand in the account. Then the next year, when it earns 8% more, it's not going to earn 8% of 2 million, it's going to earn 8% of 2,080,000. In other words, you can pay yourself out half of what it earns, keep the other half in the account, and you can keep the amount of money that's in the account, you can keep it growing so that the salary you pay yourself out goes up each year and ideally keeps up with inflation. So you can not only pay yourself a salary, but you can grow the amount of money in the account at the same time. That's called living on a nest egg and also making sure that nest egg is still growing so it can keep up with inflation. You can keep paying yourself a higher amount. And then maybe if you die, you know, hopefully many years from now, you can leave your kids $5 million instead of the $2 million you started with. So basically, if you ever come into a lot of money, if you win the lottery or something, don't go crazy. Discipline yourself. Discipline yourself and say, I'm going to put this away. I'm going to invest it wisely, and I can live like a prince for the rest of my life. Or you can take $2 million, blow it in a year, and live like a king for 1 year. And then, oh, you're out of money, and oh, that $500,000 house you bought has, oh gosh, what would that come out to? It has like 20 grand a year in property tax. Oh, so you still have to pay $20,000 a year on your $500,000 home in just property tax. You've already paid it off, but you still got to pay taxes. And you don't have an income anymore. You can't cover that. So now you got to sell that $500,000 house. So just because you get a whole bunch of money, which would be nice to have, doesn't mean you should just go blow it. You should be wise with it. That's why you see a lot of NFL players, you see a lot of athletes. You'll see NFL players who make $125 million in their career be broke. They will be broke 5 years after retirement because they did not spend their money wisely. They didn't invest it. They went and bought $50,000 bottles of champagne at the nicest club in downtown LA. And yes, there are $50,000 bottles of champagne. I don't even know what it's called because I would not dare look at it. I'd be like, no, get that away from me. That $50,000 for champagne, get out of here. Probably doesn't even taste that good. I bet it tastes gross, but everyone who buys one, they're like a high roller and they want to look rich and all that. So like, oh, this is the best bottle of champagne I've ever tasted. I bet it tastes bad. I bet it's not very good at all. So anyways, that was my rant. I like to go on a lot of rants because I like to be smart with your money. Now, realistically, most of us aren't going to get $2 million handed to us from a relative who passes away. Most of us aren't going to get $2 million that we win in the lottery. What we need to do is we need to invest our money over the years into retirement. And then maybe, just maybe 30 years down the line, we can retire, we can have that much money in an account, and we can just keep that money invested and never actually have to touch it. And maybe it even grows so that when we pass away, we can leave it to our children and our grandchildren. That's the idea of building wealth slowly over time. We rarely get a massive windfall of cash. We just have to be smart with it. You learn some of these principles, you learn about what retirement funds can do for you, you might just be able to get into that position. Let's look at another possibility. And again, this stuff's really interesting. In case you haven't caught on, this is like stuff I love talking about. Let's say you need $25,000 7 years from now. You're going to put aside an amount of money, hoping it'll grow to that amount. You can get 8.3% interest compounded quarterly. How much do you need to put aside now? So here's the thing. You have some money right now you can put away and invest it and save it. You're going to need $25,000 in 7 years. Why? Maybe that's $25,000. Maybe that's a down payment on a house. Or maybe that's you're going to buy a car with that money in 7 years. Now, normally what you do is you'd slowly save that money up over time. You say, okay, I'm going to put $100 away every month from my paycheck into this savings account. But for this case, let's say all you do is you just put away a one-time sum of money right now, don't add to it, and let it grow for 7 years. How much would you need to put aside now? Well, we know it's compound interest because it's interest that's compounded quarterly. Unless it explicitly states simple interest, you're probably dealing with compound because compound is more common. It's the only really kind of interest that exists in the world today. So we have our formula here. A equals P times 1 plus R over N to the NT power. I think there is absolutely nothing wrong with every time you work one of these problems, writing out A, P, R, N, and T. Nothing wrong. Write that out every single time. You're going to be missing one of those. That's going to be the variable you have to solve for. Now, we're not going to expect you to be able to solve for T. That uses logarithms. Solving for N would actually involve high-powered computer numerical calculations that are just beyond the scope of this course. Same for R, really. We're really only going to have you look at A or P. So A is the accumulated amount. It's the amount that's going to be in the money in the account in the future. That's actually what we know to be the 25,000. That's what you're hoping to have. P now, the principal, is what we don't know. That's going to be the one with the question mark around it. R is going to be the interest rate expressed as a decimal, 0.083. N is going to be the number of times interest compounds per year, since it's compounding quarterly, N is 4. T for time is 7 years. Here's how it's going to work. We just plug and chug all the things we know. 25,000 is A, so we substitute it. We don't know what P is, so I'm just going to write P and solve for it. R is going to be 0.083 divided by 4 raised to the 4 times 7 power. So what we're going to have to do is first we need to solve for P. We need to figure out what the heck this thing is. This whole number here comes out to, and we're going to have to divide it over. That's going to be our process. So in your calculator, this is how you might want to put that in. With all these parentheses, 1 plus, then I want the 0.083 to happen first. So I'm going to give it its own set of parentheses. Then I got to close the parentheses for this entire thing. Then I got to raise it, and then it's got to do 4 times 7. So I'm going to put the 4 times 7 in its own set of parentheses. This is going to be the best way to put it in, whether you have a graphing calculator or if you have a standard scientific calculator. So you can do that all in one line then though. Open 1 plus open parentheses, 0.083 divided by 4, close, close again, caret for the exponent, open 4 times 7, close parentheses. You can do that all in one line in the calculator and hit enter. I'm doing it on my own using my own math magic. And so now that's going to give you 25,000 equals P times, I get, and I'm going to round out to like 8 decimal places, 1.777222691. Then I'm going to divide both sides by that to get P by itself. And I'm going to end up with P equals, let me do the math here. I need to divide it using my calculator. And yeah, I have to use a calculator too, because I cannot do these in my head or without a calculator. We're past that point. $14,066 and rounding to 2 decimal places, 86 cents. Usually if it's money, you're going to round to 2 decimal places because you're rounding to the nearest cent. So if you need $25,000 in 7 years and you're able to get 8.3% interest compounded quarterly, you got to put $14,066.86 aside right now. You do that, you'll have 25 grand. So there's 2 sides to this type of problem. You can solve for the future value or you can solve for the present value, the amount needed now in order to grow it. Now, we argued earlier, we had that chart for N. We said that if you're compounding annually, N equals 1. If you're compounding quarterly, N equals 4. If you're compounding monthly, N equals 12, and so on. We argued, though, that if you're compounding continuously, N is actually going to be infinity, theoretically speaking. Now, you can't exactly plug infinity into a formula. What we instead do is, in calculus, you use something called a limit. You can take the limit as N goes to infinity. We don't go into that detail, but it turns into this formula here. It's P, if you know interest is compounding continuously. It's P times e to the RT, where P is the principal, A is the future value, accumulated value in the account, R is the interest rate as a decimal, T is the amount of time, but E is not a variable. E is a constant like pi in mathematics. It's a very, very famous constant, one that gets used quite a bit. It's about 2.71828. It actually goes on forever and ever with no repeating pattern. Hey, we learned about those kinds of numbers. Those are called irrational numbers. Now you're telling yourself, you're saying, Josh, I have to type in 2.71828 every time? No. If you're dealing with a scientific or graphing calculator, It already knows what E is because E is just so darn important in mathematics. So just look for the E button on your calculator. There may even already be a button that does E and automatically raises to a power, which is because that's usually what you're going to use E to do. So your calculator, you need to locate on your calculator where the E constant is. And then you need to figure out how to bring it up and use it in a calculation. That is what we're going to be doing. You would only have to use this PERT formula, it's called, whenever you have continuously compounding interest. Otherwise, you use this formula here. These formulas are both provided to you on an exam, but you got to know when to use what. So let's have a little fun with this. But Josh, we've been talking about money. Haven't we already been having a lot of fun? Yes, children, we have been, but let's have even more fun. Is that allowed? I think so. So let's say we have 8,000 bucks right now. We're going to invest 8,000. We're not going to slowly invest it, a little bit each month. We just have 8 grand right now in our pocket, and we want to throw that into an investment account. We want to invest for 6 years. Let's say you have a choice of 2 different accounts. The first account pays 7% interest compounded monthly. So we'd have to use this 1 plus R over N to the NT formula. Let's say the second account pays 6.85%. So on the surface, you get a slightly lower interest rate, it would appear, but it's compounded more frequently. It's compounded continuously. It turns out for the same interest rate, the more you compound per year, the more you actually end up making in the long run. So we can't do an apples to apples comparison of interest rates unless we use another formula, which we're not going to go into right now. So in the first account, so you want to figure out which one's the better investment. And it's the better investment if it leads you to more money in the end. That's how you know it's the better investment. The first account, you have $8,000. You're investing it at 7% interest for 12 compounding periods per year for 6 years. So this is how the formula breaks down. In your calculator, the way you could enter that in the calculator, you could do 8,000 times, open a parentheses, 1 plus, I'm going to give myself more space. 1 plus, then do the 0.07 over 12, not 8, in its own parentheses, close that off, do the caret for the exponent, open a new set of parentheses, 12 times 6. This will do it properly. This will do the 0.07 over 12 first, which is what you want on the inside here. This will also make the 12 times 6 happen together, which is what you want. So while it might involve a number of parentheses, it at least gets the order of operations correctly. And trust me, putting things into a calculator like this can get real nasty real quickly. Trust me on that. But if you do this, you will know the truth. And if you do that computation and you round to 2 decimal places, this first account will yield you a total of $12,160.84. So all we got to do now is compare it to the second account and see which one's better. The second account gives you only 6.85% interest, but it does accrue the interest more often. We have to use that PERT formula because it's continuously compounding interest. The way you can put this in the calculator, you can do 8,000 times. You need to figure out how you can bring up your E in your calculator. It's on every calculator. You need to find it. Remember, E is a number. So if you tell the calculator E, it knows exactly what to do. And then you can do the caret, and then in parentheses, do 0.0685 times 6. This will work perfectly. Your calculator will accept this. It will do the 0.0685 times 6 first, which is what you want. Then it'll raise E to that power. Then it'll multiply by 8,000. All of that is what we want, according to order of operations. And we end up with $12,066.60. So it turns out this first account is the better one because we get more money in it that way. Now let's make it a little more interesting. Let's say we did 6.95% interest. Ooh, Josh, you allowed to do that? Well, I guess so. So 6.95% is still less than the 7% the other one was getting, but since it's continuously compounding, let's see if it has any kind of effect. And give me 1 second. I will do the calculation. Yeah, so in this account, it's still not quite better, but you'd get $12,139.22. So this first account is still better. So it just depends on what you have. It's situational. We already did this kind of problem. We solved for P instead of A, and we just divided over by that thing. So we've already done this kind. That's not even another formula you have to memorize. All they did was divide this formula over. So there's not even another formula to memorize. Now, finally, we can talk about the effective annual yield or the effective rate. It uses the term simple interest rate in there. Don't let that throw you off. The truth is this. If you compound more times per year for the same interest rate, you actually get you get more money than in other cases. So the effective annual yield is going to be how much interest you really earned in a year. The effective annual yield is how much interest you actually earned in a year, expressed as an interest rate. So it is yet another formula that we have to look at, or you could just say, well, figure out how much money you earn after a year. Let me show you, let me do it my way. I like it my way. This time I'm gonna let it all come out. This time I'm gonna stand up and shout. So let's say you have $8,000 invested at 9%. Or even better, let's not do 8,000, let's do 1,000. Or even how about $100? We'll keep the numbers simple. Take $100, and if you invest it annually, if you invest it quarterly, monthly, and let's say weekly. If you invested at 9% compounded annually, here's how your formula is going to look. It's going to be 100 times 1 plus 0.09 over 1 raised to the 1 times 1 power. In fact, you can put it in the calculator like that. And I can tell you off the top of my head, that's going to be $109. But if you did it quarterly, you're going to have $100 times 1 plus 0.09 over 4 raised to the 4 times 1 power. That one I cannot do in my head. So let me do that computation real quick. You're going to have $109.31. So notice it's the same interest rate, 9%. But if I compound more frequently in a year, I actually earn a little bit better. In this case, if I only compound 1 time per year, then my interest rate is the same as the effective rate. My effective rate I ended up getting 9%, whoops, not 95. I effectively got 9% more. In this one, my effective rate, I got 9.31% interest because I earned a little bit better. So while the interest rate says it's 9%, if you're compounding more frequently than once a year, effectively you're actually doing a little bit better than 9%. So the 9% takes on a kind of different interpretation. If you're doing monthly, it's going to work differently. You're going to have better. Hold on, I made a mistake. You're going to end up with $109.38. So your effective rate was 9.38%. And finally, if you're doing weekly, you're going to end up with sorry, my calculator decided to clear out. No. You're going to end up with $109.41 for an effective rate of 9.41%. So the more you compound per year for the exact same interest rate, the more effectively you're getting. If you want to do continuously, you have to use the PERT formula. You're going to end up with very mild difference. That's how it works. The more you invest, or rather the more often you compound interest, the more you end up with effectively. This is kind of a sidebar way you can do these calculations. If you're trying to compare effective rates, just invest $100 for 1 year and do it at whatever rates it wants. So if you're investing $100 at 9% compounded monthly, your effective rate is really 9.38%. And there's a couple reasons for that. It just says that if you're doing it monthly, you take your 9%, you cut it into 12 pieces, and at the end of each month, you get a piece of your interest. But now, after 1 month, you have a slightly higher amount because you got some interest. So the next month, you're going to have even more than you would have otherwise because you have an updated amount. So we are rocking, we are rolling, and we are ready to get into kind of the mother lode here. We're ready to get into the mother lode of everything. Now, what we just did with simple and compound interest, we said, okay, here's what's happening there, Pilgrim. We are taking a one-time amount of money. We're either lending it out or we're investing it or we're borrowing it. A one-time amount of money, it's going to grow, and then it's going to come back to us at the end. But that's not how a car payment works. For a car payment or for buying a car, you might borrow $10,000 and you don't just pay back the full 10 grand at the end of 5 years with some interest on it. What you do instead is you make monthly payments on it. Or if you're saving for retirement, you don't just say, I have $100,000 today, I'm going to put it aside and see what it looks like in 30 years. What you really do is you say, well, I don't have 100 grand today, but maybe I can put $500 a month away into retirement, into savings. And then I see what it looks like over time. That actually creates a much more complicated situation. But there's new formulas we can introduce that will allow us to basically figure out how much we're going to have in the account after so much time. And that's our goal. That is our absolute goal. That's going to be something called an annuity. An annuity is a sequence of equal payments made at equal time periods. So for instance, if you're saving for retirement, you're putting $500 a month away for retirement. Let's say you're always putting exactly $500 away each month, and you're doing it at equal time periods, meaning you're doing it monthly. Each payment is a month apart from the previous payment. That is not the same as just putting $500 into an account, never adding to it, and just letting interest grow it, and then we take out the account at the end, which is what we have been doing. An annuity says, no, 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 we're going to slowly add to it over time. We're going to put the same amount of money into it each time, and we're going to do it at regular intervals. That is going to actually be a completely different situation. That's going to be a completely different, much more complicated, but much more rewarding situation, because that's a lot more realistic. When you're paying off your car, you're making monthly payments, you're actually doing an annuity, whether you think of it like that or not. When you save for retirement and you put $500 a month away, you're making an annuity. So here's how it's going to work. Maybe we won't get uber involved here, but think about it. Let's say you put $1,000 at the end of each year for 3 years into savings. Let's say you get 8% interest every year and it's just compounded annually. So think about it. You're doing it at the end of each year. You're doing it for 3 total times. So right now at time 0, there's nothing in the account and you're not adding anything into it because you're going to wait till the end of the year. Then 1 year later at time period 1, at year 1, you're going to throw $1,000 into it. But since it didn't get any interest in that time, it's just $1,000 into the account. That's straight up. Now, a year after that, at the end of year 2, here's what's going to happen. That initial $1,000 you put in there is going to get 8% interest. Plus, you're going to throw an extra $1,000 in there out of your own income because it's the new year. You got to put another $1,000 in. So the total amount in the account is going to be $1,080 for the $1,000 you put in a year prior, plus interest on it, plus the new $1,000. So in total, you're going to have $2,080 in that account after 2 years. Now we got to go 1 more year at the end of year 3. Well, at the end of year 2, which is also the beginning of year 3, we had $2,080 in the account. It's going to grow at 8% interest. Plus, we're going to throw an extra $1,000 into the account. We're going to throw more money into the account. And so now I'm going to have $2,246 from the previous stuff with interest, plus an extra $1,000 I put in. And now after 3 years, I'm going to have $3,246.40. That's how much is in the account after 3 years. You can imagine the computation gets nasty quickly. What if you wanted to know how much was in the account after 30 years? You'd have to do that computation 30 times and keep adding 1,000 into it. And it would get really nasty really quickly. It's easy for 3 years, but for 30 years, you don't want to have to do that computation each time. It's wild. Instead, what we're going to find is that there's a formula that will handle that for us. The problem is that formula itself is a little bit kind of wild and complicated on its own right. But anyways, if you're curious, you put $1,000 into the account for 3 years and you ended up with $3,246.4. That means you put $3,000 total out of your own money into the account. Since you ended up with $3,246.40, that means you made $246.40 in interest. So your account earned you some interest. Great. Here's the big ciabatta. We're actually going to ignore that computation for just a moment. Now here's the big thing. Here's the big formula. Behold, ye mighty, and despair. That is a nasty looking formula, but it's exactly how it works. I will show you how you can handle that formula. I'll show you how you can do it in the calculator. It's going to be a little bit ugly, but you got to find some way to do it. So now let's say P is not the present value of an account. Let's say that instead, P is going to be the amount you put into the account at the end of each period. So for instance, if you were, let's just make an example out of this. Let's say you put $500 per month into your retirement account. And it earns, about 7.3% per year. It's automatically compounded monthly because you're putting money into the account monthly. We're going to assume that. If you're putting $500 per quarter, the interest has to compound quarterly, N would be 4. If you're putting $500 per year into the account, N would be 1. How much money will you have after 30 years? So you got to put $500 per month away for 30 years. Maybe that's how much you're working. Maybe you only want to work for 30 years. You only want to put $500 a month in. This would be the formula you could use in order to make that calculation. This right here. In fact, it's usually a lot better to write it. No, I can't, never mind. But to put the P in front of this fraction here instead of up here in the numerator, it's not technically wrong. Well, I tell you what there, Pilgrim. Using this formula, let's actually make that calculation ourselves. The formula, a better way to write it, perhaps, and that's an N. It's P times this ugly business. And again, I'm going to write out the A, the P, the R, the N, and the T. And remember, this time P does not mean the principal, it's the payment. It's the amount of money that's put into the account each period. So it's a little bit different than what the formula was for just a compound interest case of just a single lump sum of money. A is what we don't know. That's what we're solving for. We want to know how much will be in the account. P, that's going to be the $500 we're able to put away each month. R is going to be the interest rate expressed as a decimal. N is going to be the number of times interest compounds per year. It is not always going to tell you it compounds monthly. It's going to have to compound at the same rate you're putting money into the account. Since we're putting $500 per month in, automatically it's got to compound monthly, and N thus must be 12. Finally, T will be the number of years, 30. So it's time to do it, friends. Let's roll up our sleeves. Whoa. Oh. That's a lot. Look at that thing in green. That's a lot. Yes, it is. How in the gosh darn heck do we put that into the calculator there, Pilgrim? Will, we're going to have to use a little bit of craftiness. Now, here's what I'm going to say. If you can develop your own method based on your own calculator for putting this in, then have at it. So you're going to need to get nice and close with your calculator. Maybe you can buy each other Christmas presents this year. You're going to want to thank your calculator after all the heavy lifting it does for you. You're going to need to get intimate with your calculator. So what I would say is for your specific type of calculator, you're going to want to go and maybe find some videos online of different strategies that you can use for putting in these finance formulas in your calculator. There's a couple of different things. Your calculator might come with a TVM solver that's going to make your life easy. If it doesn't, you can straight out use the formula like this. But at any rate, here's how I'd put it in the calculator. And it's not going to be pretty. It's going to involve a lot of parentheses. And also, let me write it out first before anyone tries to hold me to it. Ugh. That should work. If you put that all in one line in the calculator, that should work. As you see it there, notice the parentheses. We've put parentheses around the 0.073 over 12 calculation. We've given it its own set of parentheses. Then we've done the 1 plus, we put a set of parentheses around that. Then we put a set of parentheses around the 12 times 30 calculation. And we put parentheses around all that crap, right? Shmia, and then subtracted 1. And then we've divided by, so you just see there's a whole lot of moving pieces going on here. Let me double check these parentheses. Make sure that they make sense. So there's that. Then we subtract 1. Yep, that's right. Yeah, so that should work out for you. And that should be something you can enter all in one line in the calculator. Make sure to use the proper number of parentheses there. Now I have some witchcraft that I use to do this computation. So allow me to apply my witchcraft. And let me make sure that makes sense. And that should be the correct answer. Let me double check that. Yeah, that sounds about right. It's in the right ballpark. Just double check it. Yeah, done it twice. So if you put $500 a month away into retirement for 30 years, you get that much interest, which is not a bad amount. If you invest aggressively in the market, you can get between a 7 and 8% return per year on average over an entire 30 years. you'll end up with $647,353.14. Last thing, we did the calculation, we got it right. Let's say your employer matched your $500 each month. So actually, $1,000 per month was going into your retirement account. Everything else the same, how much would you have? So assuming you still got the 7.3% interest, you did it for 30 years, suddenly the only thing that's going to change is that I'm going to end up with 1,000 here instead of 500. That's going to double the amount of money in my retirement account. So that's why, generally speaking, you want to take up your employer. Anytime they want to offer you matching for your retirement account, that's a huge benefit because you're going to have $1,294,706.28 in the account. Then you're going to double the amount in the account. So yeah, if your employer's matching, yeah, take them up on the matching. Absolutely. That's literally them just putting more money into your account for you. There's certain rules about when it's considered your money, depends on how many years you've worked there. But yeah, that's exactly what you want to do. Take them up on matching and you want to invest it. If you just put $500 per month under your mattress, meaning you didn't invest it, you still had to sacrifice $500 a month and put it into savings. You didn't invest it, and since you weren't investing it, your employer is not going to match it. You would only have $180,000 after 30 years. So $500 a month, put it under your mattress. Employer doesn't match because you're not investing it and putting it into the right account. You have 180 grand. So that same exact $500 per month leaves your money. You still have to make $500 a month worth of sacrifices from your bills. You put that into the account, your employer matches it, you're investing it, which is huge. You end up with over almost $1.3 million. Clearly, it's better to invest with your employer and to invest in the market. Okay, that's all I got for you today. Thank you, guys. We'll see you on Thursday. In here, remember there's no exam this Thursday, just regular old me. So we'll see you guys Thursday. Bye now.